Welcome to this week's Armchair Trader podcast. And on the podcast this week, we have Fraser Thorne, who is the CEO of Edison Research. Fraser, welcome to the podcast.
Hello, thank you for having me on.
Today, we'll be talking a little bit more about research of stocks and how it works. But can you just give us a quick digest or overview of Edison and what you guys do?
Well, just as an introduction to myself, just to give it a bit of context, I started my career in investment, running money for a business. I started as an analyst, and then I was an investment manager for Newton Investment Management, which was a top-performing international house that was eventually bought by Mellon Bank, which then merged with Bank of New York and is now a global whale of an investment house. We set up Edison in 2003, and I wanted to take some of the principles that I'd learned at Newton's, where we had internal analysts whose job it was. They were sector experts. They weren't there to necessarily be stock pickers as such, but they were there for the fund managers to rely on, to check ideas on, to get a handle on trends and momentum. And so I set up Edison after I left Newton in 2003. We looked around and it was quite difficult to get an independent research business completely off the ground, whereby you get the funds to pay you. And you might have sort of seen the decline of CSAs and broker fees. It's very challenged. So Redburn was the great success in that space, and they recently sold themselves to Rothschilds because they were under fee pressure. So we looked around and thought, well, how do you stay in this and give yourself an opportunity to invest in the growth of the analysts? And we looked at the debt market, and the debt market, the issuer pays. So in our business model, I know it's not pure, but it gives us the cash flow that we can invest in our content and in our audience engagement. So the corporates are our fee payers. Now, initially, a lot of people would go, well, you're just going to write what they tell you to write, aren't you? And we would sort of battle back and go, well, actually, no, that's not our purpose. And we've been very successful. My director of research, he's now called the director of content and client strategies, Neil Shah. He was a senior analyst at Goldman Sachs, and he's been fantastic, along with Steve Rogers. He's the deputy director of research, and actually making sure that we built a brand that is recognized for its rigor, for its thoroughness, for its knowledge. And companies come to us to be written on by Edison because they know that we're very good at helping to explain their story. What we then do is we then work on the basis that, look, actually everybody should get access to these investment ideas and stories, and so it's all on a free to view basis, and that's quite revolutionary in that no one else has that model, whereby we don't expect anything back from the investment community, from the reader. We encourage engagement, we encourage phone calls with the analysts, we encourage access to the corporates. Really what we want to do is we want to help the corporates find the right investors, and we want investors to be able to understand everything they can about a company and take a call as to whether they want to invest in it or not. And if not, that's fine. They can move on, find another idea. So that's a little bit of an introduction to us. We're now we're about 100 people. We are a regulated entity here in the UK. We've got offices in New York, Frankfurt, Tel Aviv, Sydney, and we built our brand very much in the sort of UK growth market, and we sort of that's still very much our sort of heartland. But now roughly half our client base is non-UK, and we again think that gives us a great advantage, is that I don't believe that the right way to look at a stock is by country. I think that you look at successful investment houses like Polar. You invest by theme, you invest by sector, and then you look to find the best in class in that. They might be French, they might be German, they might be American, Nordics, or they might be British. But actually, I think markets are now much more globally interconnected, and we find that's a great lead for us.
Obviously, we've seen a situation historically where the big investment banks used to produce a lot of the equities research, and since the MiFID regulations came in, they've really scaled back quite considerably because they can't offer free research. You've seen a number of sort of smaller independent equity research houses springing up in various specialist sectors, like specialist mining or specialist biotech. But it seems to me that there's been a lot of sort of neglect, actually, particularly if you move out of, say, the FTSE 350 index or equivalent, and that there isn't an awful lot of independent research out there these days covering these companies.
Do you know what? I think that's always been the case. People think MiFID's had a big change. I mean, I'm not so sure. I think there's more information available on these companies than there ever was. You don't even need to have to wait for the annual report now. Everything is online. I mean, the way that we position this, and anyone who's going to think they're going to get something for free, you've got to wonder where's my role in this. And I've always felt that the reason that brokers don't write a lot of research is they don't make money out of it, and their businesses. I mean, the UK is one of the most overbroked markets. There's no doubt about it. It's one of the. There are more brokers per square foot minimum coverage of market caps than I think there are in any other financial centre. So I wouldn't say the UK is short of names, but the reality is that you don't make any money on trading stock, and that's fine. That's good for the investor. The institutions in the small cap world aren't largely trading stock. I was speaking to a company yesterday, and one very famous fund manager at Schroders, I think he's owned that stock for more than 10 years now. So no broker was ever going to make any money out of them. So it does drive everything towards a fundraise. That's where the fees are. There's a whole podcast on that as to quality of coverage around big deals and so on. But to come back to the point, I think that if you're an interested investor, I think that the online platforms have been hugely successful, and they've brought the power of the private investor very much to the fore, and I think that's only gonna grow. And I think that provided people do their research and you don't waste management's time, I think management of companies now are far more willing to talk to the private investor community. Yeah, I mean, Stuart, I'm not sure that are you going to see a change in the broking model? No, you're not. Free research from a broker. We like the broking fraternity. We work very closely with them. We need them because they transact the stocks that we might write on, but it's there to drive the broker's agenda. And that's why when I was a fund manager, we never looked at a broker's price target. We never looked at their recommendation. That wasn't their job. That's the investor's job.
It's interesting you say that, because I know a lot of journalists certainly pay attention to the broker's price targets, but it's interesting that the fund managers have their own ideas. I wanted to also ask you about, we've seen a lot of new investors coming into the market since the start of the pandemic, and we've seen a lot of muscle in the retail market where smaller investors have been able to significantly move prices, not just in companies like GameStop, but we've seen how the Reddit fraternity has been able to actually make an impact on shares like Pearson or Nokia. Even though maybe that was only over a short-term horizon. A lot of these investors, they're new, they're very active, they're prepared to rely heavily on social media, and we've heard about how a lot of them are using TikTok, but these are not necessarily the most reliable sources. What's your view on this sort of new wave of investment in the market right now?
I think it's fantastic. The market needs it. I think that the bigger challenge to the markets is the pacification of investment. You're now seeing the big passive funds outweigh the active funds, and there's a much bigger regulatory issue here that I know a lot of people are looking at, is that when passives are bigger than actives, who sets the price? The passives are bound up as to they've got to buy a stock that keeps growing, that therefore that inflates the value. They've got to sell a stock that isn't doing so well. Active money, liquidity is the lifeblood of any stock market. Going into specifics around how people access it, what you don't want is for people to critically lose money that's going to make a difference to their lives because they've got involved in something that they didn't really know and they kind of have just rushed into it. But equally, you don't want to be nannied. Look, it's my choice, my decision. I think it's here to stay. In the US, I mean, look at Tesla. Elon Musk drives that share price. He's got a good business and everything else, but there is a chief exec who is actively engaging with his wider investment audience, and some of it may or may not be within the the regulator's approval as to what he does or doesn't tweet. But I mean, that's private investors that are getting in on the act there. And they're making it one-way traffic. But also for some companies, not trading is even worse. You speak in any market, you go to the property market, you go to fruit market, it's difficult to establish a price, and hence a value if no one's buying or selling. So no, I think the more people that are buying and selling is a good thing. You're going to get one or two that have one-way traffic that catch headlines. And I don't know, Warren Buffett, in his annual statement was sort of very, I don't know if he was being overly protective or was perhaps a bit overstepping his mark on Reddit and GameStop and everything. But I mean, he relies on private investors himself. There's got to be a degree of protection through education, and I don't know about yourself, Stuart, but the quickest way to learn is to lose your own money. In the early days, my boss, when I first joined the city, when he joined the city, probably 3 decades before I did, he used to be lent money by his firm to trade. So they actively would teach you to, understand the value of losing money. I think that the growth of the private investor is here to stay. I think that I would actively encourage it if I was speaking to the regulators. I think that, and I just would I guess make sure that everybody does their homework as much as is possible. Otherwise there clearly there is, and there's been this read across to during lockdown there was no sports betting, so there were no sports events, so there was no sports betting, so people moved on to stock betting. Maybe they did. I think there's an element of that is some kind of human nature. More liquidity in the markets is a positive and should be actively encouraged.
You mentioned passive investment and ETFs as well. Most of them at the moment are sort of passive tracking vehicles, and they've been attracting a lot of money in Europe in the last sort of 3 to 6 months. And I notice you also cover a large number of investment trusts.
Correct.
Which is a large and established sector, and these are obviously listed, actively managed funds. Do you think that there's a role in investment for both ETFs, which are obviously very cheap, primarily passive funds, although we are now seeing some sort of semi-active ETFs coming onto the market? Is there a role for them to coexist alongside your traditional listed investment trusts, or do you think that they'll start to cannibalize each other a little bit?
Most definitely there's a role to coexist. I think they've got different purposes, different assets. Investment trusts challenge is that they're UK only. ETFs are obviously global, so their size of audience is vastly different. What's the benefit of a trust? The benefit of a trust is you've got a board, you've got oversight, and that does add to fees, but I don't think many of the trusts, they're pretty parsimonious. So there's that degree of oversight. You also can get a sort of value differential, if you're prepared to sit and wait, because you can, some things can fall out of favor and they can be at discounts. And so you are technically getting, a much better value investment if you're buying something at a discount and you believe that particular sector or their focus is going to turn. ETFs don't always have the same transparency. You're not always sure what's in them, and I think there's been a lot of reviewing. ESG has obviously suddenly hit the accelerator as far as investment themes and everything else, and in the rush to fill all the ESG ETF demand, a lot of the fund houses have created ETFs that actually still own on ESG stocks, but you wouldn't necessarily know that as a private investor. You're buying that off a platform, even if you buy it from, some very reputed houses. But no, I think trusts give you an element of human exposure. Tracking is great. Passives, ETFs, they are great because they're cheap. They are. Vanguard is fantastic, and it was much needed. It's shaken up the wider investment market. There's arguably some things that got a little bit lazy, and innovation was probably lacking in the UK investment houses. That's good, but at the same time, it doesn't always give you an ability to, as a private investor, get your extra exposure to certain areas. You might want to have 25% of your portfolio in, something that's a little bit more specific, and maybe some of the trusts can provide that. Or equally, you might buy into a fund manager's philosophy. There is an element of, I want someone else to look at this stock on my behalf. I want them to actually talk to the management. I want them to be ethical, ruthless, dynamic, flexible, and I think that's definitely a human element that you need. So no, I think trusts are very interesting. The challenge is that they are UK centric, so that means that their ability to expand is limited to the UK market.
Do you think that there's still a role for the investment trust as a vehicle? I've noticed, for example, Hypnosis, the music investment trust, has been creating a lot of media interest and is buying the back catalogues of some fairly famous names in music. That sounds like quite an innovative new strategy. Do you think that there's still a role for that kind of investment vehicle going forward, rather than just let's launch an ETF?
Yes, I do. I think that you probably wouldn't be able to get an ETF together on that. ETFs do require quite a lot of scale, and quite a lot of liquidity, so that does naturally put them into bigger global stocks. As money flows in and out, they're just, back ending it out with the physical stock on the other side. Yeah, no, exactly. Something turns up and it's interesting. Look at the success of the Scottish Mortgage Trust. It's phenomenal. There was no ETF that was going to be able to create that, that has that, you're not going to get that same. I mean, look at Berkshire Hathaway. It's not a trust in the same sense, but you're buying a philosophy. You're buying that experience. You're buying someone to check it for you. And the advantage of a trust as well, not wanting to mention the W name, but is you should have a board that provides oversight. I think that's worth a lot, because quite often you're going to buy a trust to buy and leave, and you want to know that it's been well monitored, well looked after. If it's not performing, should the fund manager be reviewed? St James's Place has been very successful at that. I mean, I know it comes in and out of press because it's a very successful business. Some people get jealous of that, and maybe they do charge, high fees, but people seem prepared to pay them. But there is that element of someone is keeping an eye on this for me. So no, I think the trust market has got many positives to it.
And you also touched on ESG, and obviously that's a huge theme at the moment. It's something that I think certainly our experience has been that investors retail investors, small investors, are getting more and more energized about. And two things I wanted to ask you about this. One is, as a provider of research, do you envisage that a lot more of your focus as a research provider is going to have to be on the ESG criteria of any particular company, i.e. its overall climate and social and governance impacts? Do you think that that's going to be a bigger piece of your parcel? And then secondly, I know that you also cover sort of the oil and gas sector. We've noticed again, and feedback from investors has been, oh gosh, why are you providing publicity to this energy stock? They're harming the planet. They don't deserve to have any kind of coverage at all. So, the oil industry in particular, the mining industry less so, they have quite a high mountain to climb as far as continuing to be able to engage with smaller investors are concerned. I just wondered what your thoughts were on that.
it's a fascinating space, and Stu, we've been interested in it as Edison and me personally for a long time. You know, what we're now seeing is probably 25 years of culmination of different people in different areas have now come together. You know, suddenly the PIR has become this body for responsible investing has now got this position. So ESG is here to stay. And from an Edison perspective, we create something called we do believe that all investors, not just ESG funds, are going to be requiring greater transparency on certain reporting metrics. And so we've got something called the ESG Edge that actually the ranking agencies, the indices, there's a of the accountants. I mean, there's a huge industry that's now built around all of this. And again, some of it's quite formulaic. You know, we got certain client stocks that they can be graded AA by one ratings agencies and triple C by another ratings agency. And that's because their businesses just happen to be in different points of development. And this is particularly impactful for smaller growing companies and even mid caps. You know, they're not yet that mature. They're not in that sort of steady state. So people now, I think lockdown with COVID has definitely brought this idea to the forefront. I mean, I think that yes, you want to make money when you're investing, but I think the large majority of investors, by virtue of the fact that you are investing, you are looking to the future. You instinctively have an element of I want to be able to enjoy that money and spend it, and I want to be able to see that it's doing good. I want to invest in companies that are going well, that are growing, that are employing people. No, it's very closely associated. You know, if you're investing in a company that's having to, it's got a sick workforce or it underpays its staff or whatever, you're kind of knowing that that's running on very thin margins, and it's likely that stock is eventually that business is might struggle and your share price is going to fall. It's like brands. You have good brands, they're good businesses, they invest heavily in the brand. And at Edison, we invest heavily in our staff in providing courses and giving everyone relevant access and healthcare because we want them to be happy. There's a very good book by a chap called Dr. Paddy Lund, and it's called Building the Happiness Centered Business. The two are very associated. So I think ESG and investing, it's moving mainstream. You look at the growth of ESG funds. I know there are cynics out there and they go, well, that's because investment managers can charge for this. Yes, they can. Yeah, they can. But you need the investment community to make that shift in order to make this mainstream. I mean, there's a business called Impacts that that's been hugely successful. With running its funds as UK listed company, it's got various funds. They've been around for 20 odd years. When they started, they were one of the outliers of talking about this of good ideas. The challenge is now is slightly ironically, there's more ESG money that can't find enough ESG stocks to invest in. I was speaking to one big fund manager, big as in by value, not by size, personal size, and the other week, and he said, look, if we want to have this stock in our ESG portfolio, we have to have a report on it. And he says that, unless it's rated by one of the agencies, that means we've got to write the report. And he says, I don't have the time to do that. So there's a disconnect that companies need to work out. They're going to have to improve their reporting. The UK is very good already. We look at stocks from all over the world. The UK is a very good, transparent market. What you can get from a website. The quality of the investor relations page is fantastic. And I do think that we are moving to a stage that is beyond just it's trendy. When you're getting, Larry Fink and people talking about this, it is now much more a conscious part of the investment management community's thinking. As far as oil stocks, yeah, we cover the extractive industries. I think that some of them are now at the forefront of Not all of them, and I think again, different territories and geographies have different regulations. But if you put the pressures on as investors, you can make a difference. That might mean it increases your cost. It might mean that it increases your cost of production. And as investors and shareholders, that's your call. Are you happy for that? The oil's going to need to be extracted. Unfortunately, the chickens need to be killed to make the chicken McNuggets, or soon to be they're grown in a lab. But right now, we still, until the whole world is able to survive on solar for our heating and our electricity and our transport or alternatives, we do still need oil as a major source of energy and gas for heating and so on. So, you can't suddenly turn it all off. But what you can do is make sure that, listen, right, if we do have to survive on that, making sure you're working with a company or you're investing in a company that is aware of its environmental impact, and therefore will minimize that impact and damage on the environment if it's a extractive industry. But there are some that they don't want to invest in it. I sometimes think that's a little bit hypocritical if you're still going to turn on your light switch and drive your car, your petrol driven car, or even an electric car is still, you've got to create the energy to charge the car. ESG is a very, very exciting space. It's going to throw up a lot of opportunities, and for an investment opportunity, companies that are involved in it, that are finding new ways of doing stuff. I think a large part of that is driven the success, the lockdown and our ability to transfer our lives into the Zoom world. That's an environmental plus, I would argue. So I think it's, we're going through a massive period of innovation. ESG is probably, it's the environmental, social, and governance, and I guess it's more, when people think of ESG and stock investments and solar, that's more on the environmental side. But the social is very impactful too. The social aspect, or perhaps the lack of communication about the social aspect, undid the Deliveroo IPO. Many of the big houses didn't get involved because they weren't comfortable with understanding what the social implications were. That's got to be a good thing.
It's obviously, ESG is obviously a big trend, and green investment is a big trend. We're certainly seeing a lot of interest in that. Electric vehicles, you've mentioned Tesla already. Anything, around that industry seems to do very well with investors at the moment. We've also seen in the first quarter of this year a lot of money going into sort of cannabis and CBD sectors again. I just wondered if there's any big sort of themes or trends that you're seeing from your side, or which you're expecting to develop further this year in terms of investment themes.
I think you've got to be looking at it in scenarios, and you've got to take your view as to how those various scenarios are going to play out. So lockdown, travel bans. If we have travel bans, then that's very good for UK domestic leisure businesses. We recently published a report on that people can find on our website. The outlook of who are going to be the winners in that space. If we have a lot of green countries announced, then airlines are going to do very well. They're going to be very busy again, and international holidays and cruises and things like that. I think those are fairly obvious. I think that the longer term trends that we see, I think there's a bigger agrarian revolution that is building up ahead of steam. I think the awareness that we need to find alternative ways to feed the world. I think that we're now arguably as individuals, we're better informed of perhaps how some of our food lands on our plate, be that meat-based, be that cocoa, be that fish, and we want alternatives, and if the consumer demands alternatives, you'll play that back through the market. So I think there's a huge opportunity in food alternatives. This is an industry that really hasn't seen a lot of innovation for decades. Now that's starting to come out, with companies needing investment and companies coming to the market. So that's really exciting. I think that health, yes, a number of stocks have done very well. The biotech space has done very well. Cannabis fits into that. We did a lot of work for a number of years with a company called GW Pharmaceuticals, that was a hugely successful business that then eventually had to go and list in the US to find a true valuation, because sadly there wasn't the depth of the market in the UK for that. A lot of people were a little bit slow to recognizing the opportunity. And I think with cannabis, you just need to be careful as to what you're investing in, because, production is really just farming. And farming has a very different valuation to drug creation, which is what the GWs of the world were doing. It's an exciting area, but I would definitely broaden that out into broader healthcare. I think that what's exciting as well is how quickly the COVID vaccines got approved. And I wonder, is that going to start to accelerate how quickly other drugs can get approved? Because there's a lot of drugs in development that regulators are quite rightly very strict about how you get approval. But might you see some of that opening up? Aging, longevity, these are things that again, I think that people are reflecting on their lives and quality of lives, accessing the grey pound. I think that's a long-term theme. I think energy remains a great theme. And within that, yeah, you do want to put the oil stocks. Many of them are unloved, but I think you'll see some of them are perhaps the best positioned to transfer themselves into an environmental aspect and play. I think share prices across the board, I was amazed personally at how well some of them held up pre and post pandemic. You will speak to an economist and they kind of go, well, hang on a minute, someone's got to pay for all this. They're in, and I'm not sure the market has looked at all of that just yet. Is that, at what point do the tax rises come through? At what point does the market slow? At what point does inflation start to come back? I'm not an economist by training, but you do see that this and that kind of borrowing has to have some kind of break. But at the same time, I think that you look around the world and there's massive efficiencies that have been witnessed in the last 12 months, massive changes as to lifestyles, as to, I think it took Disney 10 months to reach the same number of subscribers it had taken Netflix 10 years. I mean, Deliveroo or Just Eat, they're as business models, they're ideal. They're great. An app, and you've suddenly got access to all different, the variety is brilliant. And these things have come from nowhere in very short order. So I think you're seeing an acceleration of business models, and those that are successful will be successful more quickly.
My final question, actually, you mentioned the GW Pharma going to the US, listing in the US to get that depth of valuation, as you call it. After Brexit, there's been a lot of publicity about how the city is going to be damaged by Brexit, and how companies that are already listed in London are going to be looking for listing venues elsewhere. At the same time, there's been discussion about how the current listing regime in the UK ought to be liberalized to make it easier for both British and non-British companies to list here. What do you think the health of that market is in London at the moment? Do you think that it's looking robust, that we're going to see a lot more IPO activity coming through this year? And what do you think the overall impact of Brexit has been on the sort of the plumbing of the London equities market?
I think the angle of why does the GW go to the US and will others go there that's not a UK centric thing. I mean, I think Grab, the Singapore-based lifestyle app, is listed in the US, and that's just pools of capital, big pools of capital in the US. And if you're the right size, it's slightly mindset as well. The UK is a phenomenal powerhouse of ideas, of invention, of innovation, and yet somehow we haven't quite caught up in the investors, not all, of course not all, but many are sort of driven by you often find this as reasons not to invest in a stock rather than reasons to invest in it. And I don't know if this is a UK trait or maybe it's a European trait, or of I always want to get the best price, and I always try to drive a price down on a stock or whatever. So companies go to the US because they get a better valuation, and there's more money there, and that's perfectly understandable. Because in reality, it's quite an expensive exercise to go and list in the US, and there's more regulation. So I think if the UK could free itself up to more international capital, I think that post-Brexit, pre-Brexit, I thought that the UK was in a very strong position. We have geography on our side. We've got language on our side. We got time on our side. We are very lucky that Greenwich Mean Time dictates the business lives of everybody else, and we're slap in the middle of that, which opens up more economies to the UK. We're very lucky with the language, in that when we write on our international stocks, they largely want to be written on in English. So I don't think that's ever going to go away. I think from a position of UK as a centre, look, there's a North American and there's the Asian powerhouses, and India's obviously within the sort of Middle Asian space by geography. I thought that the UK strengthening with Europe would be a good thing. And I still do. Can we still do that without being tied in from a regulatory point of view? I don't know. I'm not wanting to get into the politics, but going forwards, now I think that you've got to look forwards, and that the UK has got, and London in particular, it's got an established history in finance that the other cities don't have. I hope it stays entrepreneurial. We want more stocks to list in London. We want more international stocks to list. So any changes to the regulations, I think, are to be encouraged. What you want as an investor is just to be made aware of, the changes to the share classes. It doesn't put people off buying Facebook or Google. Why can't those stocks be listed in the UK or an equivalent? But I guess as an investor, you just want to know, be made aware of, okay, so this chief exec owns X% of the stock, but owns 60% of the votes. Am I happy with that? If you are, great. So no, innovation in London. London needs more listed companies. The stock market needs a sufficient amount of scale to support the infrastructure. And there was a danger that the London market for a number of years, even pre-Brexit, and Brexit was a very difficult period because the UK became quite uninvestable. Stocks got cheaper. They all went private, so the market got smaller. We have an infrastructure. We've got scale. Some of that's going to get splintered off into Amsterdam, into Euronext is clearly a bigger challenge to the London Stock Exchange. But no, I'm looking forward with great optimism. I think that we will see more IPOs. My caveat on that is just to all the bankers, if anyone listens, please price them right. Nothing hurts the market more than getting the price wrong and going to a discount. If the investors are not happy with the price but they want to float, don't sell all their stock. Hang on to it. Keep it for a year. If they got the confidence in the business will grow, and then you can sell it. I was trained from a very early day. IPOs have to go to a premium. Have to. Now, clearly sometimes they do get underpriced. That's a state of the market. The same can happen when you're selling your house. A year later, my God, that's now worth 50% more than it was when it floated. So be it. But there is a liquidity and a transparency and a de-risking by coming to be a listed stock, which should mean it should move to a premium if it's priced right. I'm optimistic. I think the UK is well positioned, but equally it's good to be challenged by the rest of Europe. Competition is good. It will make us innovate. It will make us more accessible. I think the AIM market is brilliant. I think it's the most fantastic, well run, and I would always get behind it. I think it's the ability for interesting ideas to get on the stock market, provided you as an investor have the right information. You choose to buy or not buy the stock, but it's much better to have the option than not.
Well, thank you very much indeed for that. People can go to your website, which is edisongroup.com.
All our research is on all our content, videos, webinars, free to view. We although the investor doesn't pay, that's the way the business model works. But we treat investors very much as part of the community, and we encourage conversation, engagement, and access to the corporates. So please do have a look on the website, and hopefully there's some interesting stuff to read.
Thank you very much indeed, Fraser. You've been listening to the Armchair Trader podcast. To get up-to-date commentary on what's happening in the share markets, both in Europe and North America, and our views on some of the emerging investment stories in the small cap space, make sure you check out www.thearmchairtrader.com and sign up to our free daily newsletter.